Hi! In this video, Professor David Bresch from ETHZ will talk about insurance and reinsurance in the context of disaster risk reduction.
So insurance, in essence, puts a price tag on risk. Means it does bring risk transparency. So with that, it helps people better understand the risk, and it also helps them, obviously, to share some of that risk. That's what an insurance market is all about. Insurance, therefore, builds very strongly on the concept of trust, of mutual trust, of those who pay a premium now in order to be indemnified in case of a large catastrophe sometime in the future. Or, if luck prevails, they never have to get compensated. And that's why the premium is normally quite low compared to other means of dealing with natural catastrophes, especially compared to waiting until things happen and then try to sort it all out. But honestly, insurance doesn't operate in a vacuum. So if risks are too high, if they are too frequently happening, people are not prepared at all, and if the consequence of a catastrophe hitting a place is tremendous, insurance comes to its limits, obviously. This price tag mechanism, in the sense that if prevention to a right level is in place, then it lowers the price for insurance. And at the same time, then insurance is a very effective means to cope with the financial consequences of natural catastrophes, for example. It does not help in other dimensions. So it doesn't protect people from being affected. It also doesn't protect directly their livelihoods. It only helps them getting back on their feet after an event on the financial dimension of things. And that's very important to keep that in mind and only see that insurance has a role to play, but it doesn't play this role in isolation. So insurance as a mechanism builds on the concept of insurability. One I mentioned already. There need to be many similarly exposed risks such that the law of large number is playing. The statistics are kind of performing in a sense that if you want to insure one single individual and nobody else, it's much harder to figure how that exactly should all play out. But if it's thousands of people similarly exposed, say all of them exposed to some extent to hurricanes, tropical cyclone or cyclones, depending on what part of the planet, typhoons, what part of the planet you are, then you basically have that law of large numbers, which means it's easier to also assess risk. So number two in reinsurance and insurance is the ability to quantify risk, because otherwise it's very hard to figure what the premium might be and what the financial arrangement should look like in order to deal with that type of a catastrophe. So number two is the accessibility of risk. Can it be quantified? Can there be ultimately put a price tag to things? We use, and we might come to that in a second, a lot of models to determine this kind of the equation. And then absolutely important, absolutely key for insurance is that the risk needs to happen by chance. If the insured can influence the outcome, there's no alignment of interest. Then he could basically, the insured would trigger, say, a fire, the building burns down, and he gets a cheap way to rebuild. So you have to put measures in place such that neither the insured nor the insurer can influence the outcome or trigger the insured event. And the last one is commercial viability, again for both sides. You can, in essence, insure things that happen more than once a year. It's just very costly to do so. And then the ability and the willingness to pay for the insured, those who are seeking insurance, might be a bit limited. So it's friendly, it's just commercially not attractive to do so. And on the other hand, if people are not willing to pay anything for insurance, then it's very hard to operate for the insurance company because they do need the commensurate means in order to pay claims. There are different forms of insurance. You can either insure things once they have happened, in a sense that you indemnify people for their damages. Or you can also not directly compensate them for their loss or damage. You can also prearrange just an amount of money you're going to pay after an event. You often have that in life insurance, where if there are calamities in life, is a lump sum you get if, say, somebody in the family dies. And also on the natural catastrophe insurance, there's what we call parametric insurance, where you would say, we measure the intensity of a storm, and if that storm is a heavy storm, you're entitled to so many dollars of compensation. It's an easier arrangement in a sense. You do not need to wait to adjust the damage, the claim, to the exact location and how it played out, and people have to reconstruct. In that sense, it pays more immediately. Fast payment, easy in execution. The problem is, it could also be you have bigger a damage at your home than what you're entitled to receive. So what we call basis risk, the difference then between your amount you're entitled to get and your incurred damage. And so that's an element in parametric insurance people should be aware of. But often the speed to execution and the easy arrangements around that do play in favor of parametric insurance. Not so much, and then we come to who gets insured, not so much for the single individual. Because if you own only one home, you very likely would like to get compensated to be able to rebuild. And if then, by chance, the hurricane wasn't that strong at your doorstep and you get only half the compensation, in a parametric sense, that's not very much helping you. But the more you, again, aggregate risks, say, for a city, for a region, for a country, a parametric cover is an extremely powerful tool. And that's what we've done, especially the Caribbean, since 2009, with the Caribbean Cat Risk Insurance Facility. There's a mechanism which compensates 16 states against hurricanes, all on a parametric basis. So the hurricane hits the place, scientists and the meteorological organizations measure the intensity of the event, and a couple of weeks after, the payment is made to the government's balance sheet. And in that sense, a very fast track mechanism to get post-disaster finance, which on pre-arranged terms or pre-agreed terms. A single individual on the ground normally seeks insurance from a local insurance company. And a local insurance company therefore insures thousands of people, say in a region, in a country, in a city. Now, if that particular city or region is hit by a large catastrophe, be it an earthquake, be it a hurricane, a large-scale flood, many of these risks will be hit at the same time by the same event. So that insurance company has to pay a lot of claims at the same time. And that will very likely stress the balance sheet of the insurance company or even exceed its capacity to deal with such kind of an event. And that's why insurance companies do reinsure themselves with even larger reinsurance companies who operate on a global scale. So while one city might be affected by, say, a strong hurricane, all the other thousands of cities in the portfolio of that reinsurance company are not affected. And therefore, a reinsurance company does diversify risk of an insurance company and provides an insurance company with capital at much lower cost than would they have to borrow locally, as even the borrowers will be in stress if something is happening. So in that sense, insurance and reinsurance play together to absorb larger quantities of natural catastrophe risk. In many places on the planet, also the boundary conditions, special legal certainty, is not so much there. So people are not so sure, this game of trust, where they pay premium over years, they would ever get something back. Insurance is not the first option. It's really awareness, early warning systems. That's where you make the huge difference, and that's where you save the lives firsthand. But once you've done that, it's absolutely reasonable to think about city planning, regional planning, and how you play with all these different constituencies to better help them perform better, so to say, in the next catastrophe. And only once these elements are in place, then mechanisms, be it micro or macro insurance, can make a difference. And that's what we're then also working on, to figure what kind of arrangements would now help people, first, getting better at managing risk themselves, and then second, allowing them to share the remaining part of risk with other communities, first within the country, but then also across the border.